We have with us Dr. Sajjid Chinoy, who is the Managing Director and Chief India Economist at JP Morgan. He's also a part-time member of the Economic Advisory Council to the PM and is a leading voice in economics in India. Thank you, Sajjid, for joining us, and I look forward to this conversation.
It's great to be here, Suranjali. Thank you for having me.
So, Sajid, let's begin with something that's been worrying all of us, which is the investments into India. And we've been looking at the external account where we see that foreign investment flows have been slowing for a while. You've spoken a little bit about the foreign direct investments into India and how it compares to other countries. At the same time, we've seen that the external shocks have completely changed the math of yields on government securities across the world, and so therefore that has a bearing on currencies in the Asian market. But that being said, the trends that we've seen in foreign direct investment have been building up for a while. And in the domestic economy, we've also been trying to answer the question of why investments have not been picking up. So, Sajid, do you think that there are common causes there, or what do you think is holding back investments, whether that's foreign or domestic in India?
Thank you, Suranjali. A great question to start off with. So let's take it unpack them one at a time. I think it's first important to understand that the pressures that we're seeing on the balance of payments in the rupee over the last 18 months or 24 months have a different genesis from the past. In the past, there was this prototypical evolution where the economy is sometimes doing well, but also overheating, and the current account deficit balloons. We saw this in 2013. We saw a little bit of this in 2018 as well. And when the current account balloons, then you become reliant on fickle capital flows at the margin to finance it. There's a shock somewhere in the world, there's a sudden stop of flows, and the balance of payments comes under pressure. And in those situations, you can't control the exogenous inflow of capital flows, but the current account is bloated. So what is the first best? You basically indulge in expenditure compression. You tighten monetary policy, tighten fiscal policy, and try to bring the current account back to sustainable levels in the hope that the balance of payment pressures will abate. This time is very different, right? And it's different because the current account has been very benign. For FY27, the current account is going to be 0.7 or 0.8% of GDP, much below the levels that we would deem sustainable, right? Or threatening. Over the last 3 years, the CAD has averaged just 0.8% of GDP. Instead, the pressures, as you alluded to, are firmly stemming from the capital account. Capital flows used to be 2.5, 2.6% of GDP between 2014 and 2019, and they've virtually completely dried up in 2025 calendar year, right? What's causing that? If you look at the decomposition, net FDI has actually ground to a halt. Gross flows are still coming in. As a share of GDP, they're still not back to where they were, pre-COVID. But they're coming in. It's the repatriation and outbound FDI which has picked up very sharply, such that net FDI has been much, much lower and is largely responsible for the slowdown in capital flows. Added to which you've got foreign portfolio equity, lack of inflows and now outflows compounding the problem. So the question is, why is this happening? And in some work we did a month ago, what you find strikingly is if you were to map India's net FDI as a share of GDP over the last 15 years, you find a striking correlation with US 10-year yields, right? It's very closely correlated with global interest rates, which is in a way a proxy for global financial conditions. Now, this is just a correlation, not a causation, but why does this matter? Because we know that FDI is a function both of pull factors that are country specific and push factors that tend to be more global. And it seems like the last 15 years, India's net FDI has been very much a function of push factors. When global financial conditions are benign and interest rates are close to zero, like we saw in the pandemic, India got a surge of net FDI. In 2023, as the Fed began hiking rates in 22, and end of 22, 23, you see US interest rates go up, 10-year yields go up from less than 1% to over 4.5%. Global financial conditions are tightening. And that's why a lot of India's net FDI has dried up, right? So, in a way, when you rely on push factors, then you become hostage to global financial conditions. Financial conditions have tightened, that's dried up our net FDI. And the worrying part is that going forward, there's a sense that given how sticky inflation in the US is, that the Fed now may be forced to raise interest rates. We know the US fiscal situation is very precarious. And so large term premia are built into US yield curves. And therefore, it seems like US interest rates and 10-year yields are going to remain elevated. And these push factors are going to remain, quite threatening. So I think the first point to recognize is that a lot of this is net FDI and happening because we're relying on push factors. And then the implication is we need to be relying more on pull factors. And this is where in our own history, there's a great natural experiment because between 2005 and 2010, you got this big surge in domestic private capital investment, a private corporate capex cycle. And what do you see in that period? FDI is very strong into India, despite the fact that US interest rates are elevated. So that was the 5-year period where India got pull FDI, right? And so the question then is to link both your questions. If we need to attract strong and sustainable FDI flows to safely finance our current account deficit, for me, I think going back to first principles, we need to get a domestic private investment cycle going again because FDI is complementary to that. And so the real question is, why have we not seen corporate capex pick up so far? I think there are two phases to break the problem down into. Between 2012 and 2018-19, it was very much a supply side problem. We know that we had the twin balance sheet problem that India had identified. Net NPAs on bank balance sheets were elevated, leverage on corporate balance sheets was very high. So it was understandable that corporates would not be investing till they cleaned out some of their balance sheet problems. And that took almost a decade. But since 2020, the opposites happened. The bank balance sheets are very clean. Net NPAs have been the lowest since 2011. Corporate leverage is down to decadal lows. Profits have been strong. Cash levels are high. Why aren't corporates investing? And in fact, if you look at the new GDP series, what you find is as a ratio of GDP, this is now at 10.5%. It used to be 15, 16% in the heyday of 2006, 2007. My view for a long time has been that we've gone from a supply side constraint becoming binding to a demand side constraint becoming binding, which is to say that I think corporates in this world we live in need more demand visibility to be able to invest. If you look at capacity utilization rates in manufacturing, they've been plateauing around 75 or 76%. Now, in a world where China's got so much excess capacity, and China is exporting that excess capacity around the world, into Asia, into India, you need a higher bar for utilization rates and demand visibility to start investing. You see, Chinese imports are flooding into India. Our bilateral deficit is ballooning. Core inflation, correctly measured, is below 3%. So if you're an Indian corporate and your utilization rates aren't going above 75%, you have to compete with these cheap Chinese imports, which is hard to. And core inflation is less than 3%, which is good for households, but not good for pricing power for firms. It's understandable why corporates have not invested. So I think the short point is we've solved a lot of our supply side problems, which is the good news. I think the issue is now how do you inject more demand visibility, right? Through consumption, through exports, through public investment. And the government's been trying. It's pushed hard on public investment in the last 5 years, precisely to crowd in private investment. So you need that visibility. And the fact that you've got so much geopolitical uncertainty, so many shocks, a COVID shock in 2020, a Russia-Ukraine shock in 2022, then a tariff shock in 24. Now we've got another war in the world. That doesn't help the cause.
Thanks, Sajid. And I want to follow up with a question on the technology side or the technological breakthroughs that we're seeing. So at the moment, I don't think that analysts can agree on what they think of AI, but it seems to be a sector which is receiving a lot of private financial flows in the US. So you see the credit market as well as the equity market being very optimistic, despite some analysts saying and comparing this to the South Sea bubble or the tulip mania. So one is to ask you that, how much do you think, what do you think of AI's prospects? And second is to say that, is part of the lack of investments attributable to India's inability to, put its foot in the door in terms of AI? Or do you think that that's one of the causes?
Yeah, so I think the AI question is a kind of a this $1 million question that people are grappling with, and I think both things can be true. That in the medium term, this is an incredibly productive technology. And I think we're all finding out in the last 6 months as you begin to use some of these AI applications, Claude and ChatGPT and Mythos now, that there's a certain proof of concept that is being achieved. And I think some of the excitement and the mania that you're seeing in recent months. In fact, I look at all of Asia now, and Asia has been a huge beneficiary of this AI boom in the US because all of the high-end chips, logic chips, memory chips that go into US data centers are produced in Taiwan, in Korea, in Singapore, in Malaysia, and Vietnam. So the Asian economies have been huge beneficiaries of this. And there was a sense that, by 2026, the mania would begin to cool. But in fact, the opposite's happened. We've seen even stronger demand in the last few months because some will argue that, the proof of concept has been achieved and people think this is a transformational technology. Now, there are many caveats here. The first is you've begun to see that the Mag 7 have begun to take on more leverage. These are not just existing cash. So the question is, do you get into an uncomfortable zone where they take on a lot of leverage, but it takes much longer to monetize this? Number one. Number two, the existential question about what this does for the haves and the have-nots, right? That AI, to what extent will this be labor augmenting, and to what extent it's going to be labor cannibalizing, right? And there again, we come to this concept of Givon's paradox. This economist Givon, in the 1800s, and spoke about this in the context of coal. That the sense is that with AI, things are going to get more automated, and jobs are going to be under pressure. But the Givon's paradox is that as the price of something falls, we tend to consume more of it. So, in a way, think of this as movement along the demand curve versus a movement off the demand curve. And the demand for labor may fall vis-a-vis capital, but to the extent that things are getting cheaper, will we consume more of that product, and that creates more jobs? So I think there are fundamental questions here about what this does for employment. And the examples often used of MRIs and PET scans, that what you've seen is, in the recent decades, the price of these things have come down 60%, 70%. The demand for this has gone up, and that's created more jobs for radiologists, not less. So I think this is an open question. What I will say, Suranjali, is that even the build out of AI, quite apart from the adoption, is very capital intensive. What we've seen in Asia is quite revealing here. Taiwan has been the epicenter of the build out. This is an economy that grows at 3% typically. Last year, it grew at close to 9%. This year, it's supposed to grow at 9%. But because all of this is driven by one narrow sector, which is so capital intensive, this AI export tech boom in Taiwan translated to almost no jobs being created, such that the government had to undertake universal, unconditional cash transfers for the entire population last November because one sector was booming, but there was no spillover. You're seeing that same tension in Korea right now, where with Samsung, for example, labor unions threatening to go on strike. SK Hynix is another company, and labor is now going is been promised profit sharing. So I think AI, you're going to see great productivity growth, but you're also going to see this tension between capital and labor. And the last thing I'll say is both things can be true, as we saw with the telecom bubble, that in the long run, this is a very productive technology, but there can be excessive mania in the short run. And so you could have a bubble that unravels in financial markets, but that doesn't mean that the underlying technology is not very productive going forward. So there are many elements to AI that we need to keep in mind and we don't know enough about.
That's interesting, Sajid. So you're saying that it's still wait and watch, even though we're seeing some early signs that there are some costs to labor uh, from specializing in this sector.
And you're
So
also
that
right that it has sucked up a lot of capital, a lot of flows, capital flows are going to the US, which is the epicenter. A lot have gone to Korea and Taiwan. And that means those that are deemed part of the AI supply chain are the big beneficiaries now. Those are more consumers and less users, are being deprived of capital. So that's true as well.
Yeah, so that's interesting because there's a recent paper by the Bank of International Settlements which looks at the concentration of AI firms across the world. And in a sense, it also then defines the concentration of capital across the world, which could have implications for countries like India.
Absolutely. And for me, the biggest concern is, we've already seen that manufacturing has become so much more capital intensive, including in India, so much more automated, which makes job creation more challenging. And now, if services become, that much more automated because of AI, for a country like India that depends on high value services, what does that do? Now, we're seeing that if you look at the legacy IT companies, hiring in those companies have stalled in the last few years, but you're seeing a lot of GCCs mushroom and service jobs are creating there. So I think this will come down fundamentally to that Devon's paradox, that are we going to be in a situation where services get more automated, or because of AI things are becoming cheaper, people are consuming more of it, and that creates more service jobs, especially because I think services is where India has the big arbitrage. When you get skilled technical people, English speaking people in India, it's much cheaper in India compared to the US, for example. I think that's where we stand to gain.
But do you think, Sajid, that that would still leave us among in the low value add segment of the tech industry? Uh, what's your view?
Well, it remains to be seen. I think it's too early yet. We the question is that in the tech supply chain, you've got the infrastructure part, you've got kind of the foundation, you've got the building of the data centers, you've got the foundational models, you then have commercial applications. The hope is that India has the kind of the experience and the critical mass of companies that will be good at developing commercial applications of AI that can then be rolled out. But I think there's a broader issue here, Suranjani, when we talk about this capital labor tension, which is that we're in a world in which for job creation, whether it's AI or the automation of manufacturing, we have to, and if you look at India's annual survey of industries data, what you see is the capital intensity has picked up very sharply for the last 20 years, right? And so we need to guard against that. And I think for me the antidote is, how do you prepare labor to compete best with capital? And that means you're doing the old but really important stuff: education, scaling, health, retraining. And I think that has to be a key focus area going forward, that when entrepreneurs are choosing their production functions, how much capital, how much labor, given India's demographic outlook, we're giving labor the best possible chance to compete vis-a-vis capital. And I think that goes back to, again, in this whole AI system, we talk about the importance of knowledge creation and having that ecosystem of universities and research, developing and designing these large language models. Ultimately, it just boils down to making investments in education, in developing an ecosystem of learning and research that we will have to continue pushing on, because we're getting into a world where these capital and labor trade-offs are getting more acute, and we have to arm labor better to compete with capital effectively.
Thanks, Sajid. I'm going to shift a little away from this, but sort of related, is to talk about the emergence of industrial policy. So last year or the year before, there was a very interesting report by Mario Draghi talking about competitiveness in the EU, lamenting a lot about how the EU has lost out on attracting large tech companies just because of the regulatory environment there. And then there are other countries that, after the shock of the tariff, realized that they need to specialize in domestic production. They need to focus on domestic manufacturing. And so industrial policy made a comeback, and many countries are looking at it as a tool to improve output. So I would ask you this: that do you think that industrial policy could be a way of augmenting innovation or productivity in economies? And what do you see as the future of industrial policy across the world?
So I think one needs to make a distinction between deregulation, when you've got excessive regulation, in Europe or in countries like India, and active muscular industrial policy. I'm all for the fact that you need to deregulate. You don't want businesses to be shackled in a world in which companies are now actively deciding what their China plus one strategy is going to be. Global supply chains are getting reconfigured. India wants to provide the best possible investment environment to firms to come here, and that will mean deregulation, focusing on factors of production, openness to trade. I've been very heartened to see the government's approach over the last year has been not to close down, but to sign a series of free trade agreements. And most people that study this closely will say that the deals with the EU and the UK are relatively deep. And also, the other element of that is to reduce import tariffs and non-tariff barriers like QCOs, because as we know, an import tariff is equivalent to an export tax. So I'm all for creating an environment which is more export oriented, deregulation, cost of business coming down. But I'm a little bit wary of industrial policy by itself for a couple of reasons. In this world of, we spoke about technological change, such dramatic technological change. I'm a little bit more comfortable when the market decides where resources should be allocated. I'm fully buying the fact that for strategic reasons, right? So, if you indulge me for 6 minutes, what the last 6 months has also shown us is that there are many choke points that countries are exposed to. So in India's case, a lot of our LPG was coming from the Strait of Hormuz. A lot of our gas was coming from Qatar. A lot of our APIs, especially in antibiotics, 90% of the APIs come from China. Polysilicon that we make for solar panels comes from China, for many countries, including India. So there are all of these choke points, and I'm all for the government to identify the choke points and then mitigate those choke points either by building buffers or by diversifying imports, right? And if there's very specific areas that we need to produce at home for national security, I'm completely for that. But I'm a little bit wary about broad-based, across the board industrial policy for at least three reasons. Number one, um, when governments around the world are picking winners and losers, I worry at a time when there's such dramatic technological evolution that there could be a misallocation of resources. And we've seen that, in some countries, and we've seen this in our own history here. So I think one, we need to be wary about governments replacing the role of markets in picking winners and losers. Second, about efficacy, everyone is doing this. If you look at, there's a database now that tracks all the industrial policy the last 15, 20 years. And what you're increasingly seeing is tit for tat industrial policy. Country A does it to country B, and country B does it to country A. In that case, whatever competitive advantage you have through industrial policy gets washed away. And so I think of this as the prisoner's dilemma, where both countries engage in industrial policy. There is no competitive benefit because each has undone the other. And yet both countries are paying a fiscal cost and paying a resource allocation cost. And the third reason I'm wary is the fiscal cost of this. China is seen as the poster child of industrial policy, China spends almost 5% of GDP on industrial policy every year. Think about what 5% of GDP can buy you in terms of, what we just said: health, education, skilling, retraining, human capital augmentation for your labor force. So therefore, I think in narrow pockets, when there are strategic reasons, it's understandable. Broad-based industrial policy, I think, is not advisable. But you're right. I think this is where the world is going, and we need to be very careful to avoid the demonstration effect of what's happening with industrial policy application around the world.
Thanks, Sajid. So just on, final question, which is that about 2 decades ago, you wrote a book with Anne Kruger on reforming India's external financial and fiscal policies. And my question was just to sort of ask you to reflect a little bit on, do you think some of those suggestions or ideas have been implemented, and what therein still remains to be done?
That's a great question. That was a long time ago. No, I think India's made significant progress on there. I think first and foremost, our financial system has developed so much. All right. We still have some credit deepening to do, but we've become far more mature. That the system is broader and deeper and much more sophisticated. So I think that's clearly a positive. I think I would argue that there's been huge strides made on macroeconomic stability, right? That ever since the 2013 taper tantrum, India has institutionalized macroeconomic stability, inflation targeting, which I think has worked very well. We have a fiscal framework in terms of debt, a credible fiscal framework, which I think has reduced uncertainty in the bond market, reduced risk premium for sure. There's an effort to has been to build significant foreign currency reserves, which has held us in good stead. So I think, yes, the current situation of low capital flows is an aberration, but in general, India is seen as being very secure on macroeconomic stability. So fiscal, monetary are very much in sync. So I think huge progress on the financial system. We've seen a lot of progress on macro stability since the pandemic. A lot of progress on public investment, which has become the government's priority. And generally, many of the supply bottlenecks that India used to confront, we were always a supply constrained economy, lending capacity, right, agricultural production. Those have the government has been working on and whittled away. I think where we need to see more progress, is the age-old question of India becoming more open. Because I keep citing this, we need to grow at about 8% in per capita dollar terms if India has to get anywhere close to a high income country by 2050, right? Only 13 economies in the world have grown at 7 or 8% for 25 years at a stretch, which is what India needs to do. And those 13 economies all had one thing in common: they were all driven by export led growth. So I think that's a theme that we wrote about, 20 years ago, 25 years ago. And that theme is still true. It's a more challenging global environment. There's no doubt about that. And it's going to be tempting to believe, oh, India can grow at 8% just by virtue of domestic demand. But that has never been true of any country over the last 100 years. So it just means that we have to still have that export led mindset. And I'm very happy to see the government in the last 12 months adopt that mindset, both in terms of the number of free trade agreements as well as what we're doing on the import front. But there's much more work left to do over there. And then I think, the other two things that I would say that we still need to work on is, of course, factor market reforms, land, labor, power. How do we become structurally more competitive? I think that's the key here. Because to grow our exports, this is going to be a lesser case of a rising tide lifting all boats. India will have to increase its market share, and that means becoming structurally more competitive. And I think the most important of all, I think, is just human capital augmentation. The thing that binds all of this together, AI and production becoming more capital intensive. How do we augment human capital? Health, education, skilling, training for. So I think lots has been accomplished, but as is always the case in the journey of an emerging market, lots always remains.
Thank you so much, Sajid, for your time. Lovely speaking to
Always a
you.
pleasure. Yeah. Thank you.